Out of the last 100 tax plans that I've built for high income earners, only 12 of them ended up giving my clients a 6-figure tax savings. That's it, 12 out of 100. Now, out of the rest of them, most of them are 5 figures. I won't take on clients. I don't expect to more than double their tax savings compared to my advisory price. But it's not the kind of tax savings that's life-changing like the top 12 had when they walked away with my tax plan. And to me, the most interesting thing about all of these 12 tax plans is that they weren't built for the wealthiest clients or the smartest clients, and they weren't even built for the people who had the most real estate experience. They work so well because of a specific set of decisions that my clients made that almost nobody else will do. So in this video, I'm gonna walk through a breakdown of exactly what those 12 plans had in common, and then I'm gonna show you why the other 88 fell short of getting the 6-figure tax savings, so you can figure out which side of the line you want to be on for yourself. Okay, let's get into this. The first thing that every single one of these 12 tax plans had in common was that the client was paying a marginal tax rate of 35% or more, so 35 or 37%. That's basically for those making over $500,000 a year. And the property they bought actually matched their income level. I know this sounds obvious to some of you, but it's one of the most common parts I see tax plans fall apart. People just buy a property that's too small for their tax situation. And no matter how perfect the rest of the strategy is, the deduction they generate just isn't big enough to produce a sizable amount of tax savings to move the needle. So let's take some examples here. So let's pretend that we have client A. They make $300,000 a year from their high income W-2 employment. And so they're gonna fall into the 24% tax bracket. If they go buy a short-term rental for $500,000, that short-term rental with a cost segregation study, assuming they meet all the requirements for the short-term rental strategy, is going to produce $100,000 in non-passive losses. Now, because they're in the 24% tax bracket, and just to keep the math simple, that's gonna generate a $24,000 tax savings, 5 figures. And that's meaningful, but it's not 6 figures. It doesn't make the top 12. In contrast, let's take that with client B, who makes over $1 million a year from their W-2 job. They obviously fall into the 37% tax bracket. And let's say, because they make over 3 times as much as the $300,000 earner, they go and buy a $1.5 million short-term rental, so 3 times as much in terms of a purchase price. That short-term rental, again, assuming they meet the short-term rental strategy, they perform a cost segregation study, and the results are similar, that's going to produce a $300,000 non-passive loss. Now, at a 37% tax bracket, they would get a $111,000 tax savings. They have to put in the same number of hours, right? That 100 hours and more than anyone else. They both acquired a short-term rental. They both put in capital. Different amounts for sure, assuming they have an 80-20 on their financing versus their down payment, but they have vastly different tax brackets and purchase prices, which are going to get them to very different tax savings amounts. And let's actually just take that one step further. And let's say that client B making that over $1 million in W-2, if they went and bought a $500,000 property, just like the person who's making a third of the income that they are, they would only be generating a $37,000 tax savings. That's still really significant, and that's meaningful. But it's not the top 12. We aren't even getting to 6 figures yet. The main difference is they bought a much larger property with a much higher depreciation basis. So why is it that some high income earners are gonna buy a property that's way too small for them? Well, it could be all over the place, but one is probably just risk aversion, especially if it's your first one, or maybe unfamiliarity with the real estate, or maybe they got some general advice from some CPA in the past or someone online that said you should really just start small. But the cost of that mindset is going to be huge from tax savings. All of the top 12 plans bought higher purchase price properties because they are at a higher income in the 35 or 37% tax bracket and were able to generate 6 figures in tax savings just from this one strategy. Okay, quick pause before I move into the second pattern that I've seen. What I'm walking you through right now is the type of analysis I can do with my clients at Carrier Tax Consulting. We don't build cookie cutter plans. We'll look at your income, we'll look at your goals, your risk tolerance, and where you want to go with your family's wealth. We want to build a tax strategy plan for you that actually moves the needle. If you want to know what a 6-figure tax plan could look like for your situation, the link to a call is in the description below. Okay, let's keep going. So the second pattern that I noticed is that all of these 12 plans were set up correctly with the right strategy at the right time. Their documentation was tight, the timing was correct, not in December. By doing this the right way from day one, they lock in their tax savings rather than gambling that the IRS is not going to come look at their tax situation or documentation a few years down the road. The other 88 plans had something out of place that just wasn't going to work. It was too late, it was the wrong strategy, or they had the wrong documentation. And that wrong documentation was going to cost them significantly. And in the tax strategy world, especially dealing with the IRS, one piece of documentation being out of place is what will cost you severely under an audit. So what do I mean by being set up correctly or the right timing and documentation? First, they came to me before they acquired their first property, or sometimes people come to me after they've got a property under contract or they just bought it in the last month. They started tracking their time for material participation right before they had their first booking, not the next year. And they were keeping contemporaneous time logs throughout the year with my oversight on a regular basis to confirm they were on track and they were documenting the correct things. Now, contrast that to someone who bought a property last year or several years ago. They haven't been tracking any time on their time log for material participation, or they come to me in the middle of December and say, hey, what can I do now before the end of the year? Now, although there are some things you can do that late in the year, it's pretty small compared to what you can do when you're starting to do tax planning. So even if they were going to get $111,000 in tax savings, if they don't have documentation for the IRS under an audit, all that tax savings is zero. And then you add on top of that penalties and interest, and it's actually worse. All 12 of these winners had a tax plan in place beforehand, not after. That's the whole point of a plan, isn't it? So just to pause here for a minute, when I have clients come to me, kind of what my onboarding process looks like is I look at the last 2 years of tax returns. I'll also have them fill out a questionnaire, which is going to help me really gauge where have you been compared to where are you trying to go, and what is the confusion, what are the issues and goals that you have that I can potentially help with that you feel like you can't do on your own. From there, then we actually craft a plan that's specific to you based on your income, your goals moving forward for acquisitions, investments, capital available, timing that you have. Maybe you've got some fluctuations in income or some changes in employment, or you're thinking about selling some properties, whatever it might be. That helps me create the actual tax plan, and then phase 3 of working together is actually implementing that plan together. So that's a little idea of what tax planning looks like with me. Okay, and the third pattern, and this is one that I often see missed as well, the best 12 plans don't rely upon a single tax strategy. They're stacking multiple strategies together. Usually people who come to me are thinking about one thing, like the short-term rental strategy with a cost segregation study, and that's okay. Those are great strategies, but potentially on their own, they might not get the tax savings that you're looking for. The clients who typically hit the 6 figures are typically stacking multiple together. So for example, let's say that I have a different client, client C, and they're actually making $750,000 a year. They're in the 35% tax bracket. And let's say they also go buy a $1.5 million short-term rental, and they're gonna generate a $300,000 loss from that property. It's gonna equate to about $105,000 in tax savings on that property alone. And poof, we've already got our 6 figures, right? They also added in shifting income to kids, which maybe adds another $3,500 in tax savings, plus some retirement plan and HSA optimization for another $3,500, plus some charitable bunching for $10,000. That gets us to a total tax savings of $122,500. And to most people, that is very exciting and can move the needle for their tax situation. So yes, there was a core strategy that added to 80% of the total tax savings here, but when we stack them together, we're just compounding some of the benefits here. And the reason that a lot of people don't stack is usually they're just going for the one strategy and they're okay with that, right? It gets them to a income or tax savings amount that they're happy with. But oftentimes too, it's just they don't understand. They don't understand the other options, which is part of why we do some tax planning to potentially expose people to other recommendations and how it works and the documentation and how they do this. Or they've just been working with some other CPA who's never wanted them to do it or said there's a lot of risk, and therefore they haven't moved forward because really the CPA doesn't understand it or they're scared of it. The 12 winners worked with someone who could see the full picture, fully explain it to them, and help them implement something that they were comfortable with, as well as the CPA was an expert in. So that's a summary of what separated the 12 winners from the 88 others. 1 is right-sizing the property based on your income. 2 is the right timing in documentation from day 1. And then 3rd is stacking the tax strategies together. And the reason I made this video is because most high income earners today are doing 1 or 2 of these kind of main components, but rarely are they doing all 3. And that's the gap. That's why the results vary so much from one tax plan to the next. If you want to see one of those tax strategies used, like cost segregation studies, go watch my video here, which I'll link in the video, and I'll see you on that video.